people that were expecting the bear market sell off, I think that they're going to be highly disappointed. Hey, finance fam, welcome back to my channel. In today's video, I'm going to talk through my stock market predictions for 2024. 2023 left a lot of investors very surprised by how strong the stock market performed. I want you to go into this year with confidence that you have your head wrapped around the data and what to look for and how to read the price action. So let's dive into the S&P 500 chart. So the S&P 500 all-time high, as you can see here, this was around the 4,800 zone. So what we've done in 2023 is we had an over 24% rally. So the stock market basically ran year to date over 24%. And we rallied into this all time high zone. We did not make a new all time high, but we got pretty darn close. The NASDAQ 100 index, which measures a lot of tech companies, did in fact make an all time high, just to note that. So essentially, I want to talk through what I'm seeing in the price action, how it's trending, in my opinion, bullish or bearish, and what I think could happen from here based on the data that we have and how things have trended in 2023. Being a trader and investor, you're constantly looking at possibilities and probabilities in the market. What happened is a pullback or rejection at the all time high test. I wrote about these possibilities in the Daily Doe newsletter. If you are not subscribed to that newsletter, I'll link it in the description below because this chart is literally my markups from that post. And what ended up happening is the pullback or rejection at the all time high zone, which does not surprise me at all. What we're seeing now is a little baby correction, but it's not a lot. Like this is a very what I call shallow pullback in the stock market in the S&P 500 specifically. Really, from here, what I'm looking at is there are a few support zones we could be watching. We need to be watching this 4,700 zone. And the next possible zone that we could sell off to is going to be this 46, call it 4,600 support zone that actually does go back to March of 2022. So I would say that's a pretty important support level that buying could end up happening around. I call it the dip buyer zone. So my anticipation is that if we do see price sell off to this dip buyer zone, which I need to move this a little bit. There we go. Then I think some people who have been sitting out of the market, they have been probably waiting for the market to pull back to add capital in because they've been out of the market because of the recession fears. Well, they might see that as an opportunity to pile back into the market. Now, if we end up breaking down, below this support zone or this dip buyer zone, then we'll have to reevaluate and kind of see what's going on at that time. It's very possible that it could, but I'm anticipating that we're going to really see this correction be a little more short lived as dip buyers are chomping at the bid to get back in the market because there is a lot of cash out there in money market funds that could be looking for a home in the market after seeing the returns that we saw this year in the S&P 500. Now, I do think it is very possible that we could see a new all-time high this year. But that doesn't necessarily mean that I think it's going to last very long. So, something that I talked about in one of my prior videos in 2023, I mentioned it a few times also on the We Talk Money podcast, was that I can see us shooting for an all time high and seeing the big correction that everybody's looking for or the big sell off that everybody's looking for coming from higher levels. That is essentially playing out right now. But something that I do think could happen based off of things like the price to earnings ratio of the stock market, things like earnings forecasts, which I'll kind of dive into these a little bit more, things like certain economic data, which I will dive into shortly. But putting everything together, I essentially see the potential for us to truck higher in the stock market and potentially not see a correction until we've made that move higher. The correction may not get us to levels that people want it to. So people that were expecting, all-time lows, us to kind of retest this low here and continue lower, people that were expecting that big bear market sell off, I think that they're going to be highly disappointed. A more likely scenario, in my opinion, could be something like we end up breaking out all-time highs, okay, and we do see a run, we see higher prices, and then from there, that's when we end up kind of seeing that big correction. But, it may not get us very much lower than where we are today, and that's the whole point that I'm trying to make here. So you might be thinking, "Wow, Nikki, you sound really optimistic about 2024." Well, let me kind of back this up with some actual data. Let's start with the forward price to earnings ratio of the S&P 500. The red line here is the large cap, so the S&P 500 index. And essentially, we are not at a cheap price to earnings ratio, which, if you don't know, I've done videos on this before, but the price to earnings ratio is essentially a measure of how expensive or how inexpensive the stock market is. So the higher the number, the more expensive. The lower the number, the cheaper it is. And you can see historically by the red line showing the S&P 500 that we are not in expensive territory like we've seen in the past, but we're also not in cheap territory like we've seen during recessionary periods or like we saw during the pandemic. So we're kind of like in this floating, zone where people aren't really super excited to allocate capital to stocks because we're not really seeing a huge value. But at the same time, we're not at max exuberance and there could be more room for upside. And the reason that I say there could be more room for upside is based off of earnings estimates. So we have to remember that the stock market price is based off what corporations earn in their businesses in terms of profits. So what we are expecting for 2024, measured by the blue line here, is about 250 in earnings per share, which essentially is a bump up from 2023. And earnings per share is what helps us calculate our price to earnings ratio, which tells us if stocks are cheap or expensive. And when we think about how the market likes to think forward, well, the market is also thinking about 2025 earnings estimates now. And that is expected to be higher than 2024. So you could justify that if you are a long-term investor and you're going to be invested, into 2025 and beyond, that the stock market is actually not too bad looking here in terms of value. Let's just do the math here. We have 274 earnings per share consensus as earnings estimate for 2025. So let's take that number and divide it by the price of the S&P 500. If the S&P 500 is running at 4704 and the earnings estimates are going to be 274 per share, and that gives us a PE ratio of 17 times. Okay, so let's take that back to our little graph here and look at where 17 times PE puts us. Well, 17 times PE is actually, about average. That's not a terrible PE ratio. It's a PE ratio that I would probably happily invest in. So that alone could be an argument in terms of, the future as to why you could justify buying stocks here, even though we've already run, 24% in 2023. It can also justify why we could end up kind of sticking around this range of PE ratios between 16 and 20. What that does is it goes back to my point of how the market could end up being a little bit choppy. We might see a run to all-time highs, maybe a little higher, and then we correct and we pull back, maybe back to where we are now. And we kind of see this up and down going on where until we have confirmation that companies are going to be continuing to earn more and more, this is all justification for this bull trend that we're in to actually continue. And you might be thinking, but Nikki, the credit card debt, the savings depletions. And I hear you, but let's take a look at something. Consumer debt payments as a percentage of disposable income is a measure that I've been following very, very closely. If you've been watching any of my YouTube videos, I've been talking about it a lot. And essentially, we are worried about it because people are using their credit cards a lot. But here's why I think we could end up being okay. If the unemployment rate continues to stay low, which There's no sign that that is going to be changing anytime soon. It could change at any time. Of course, anything can happen, but things have been slowly and steadily very historically low in terms of unemployment rates. Well, if we have that, that might help consumer debt payments as a percentage of disposable income kind of stay under control. We were a little worried that this was going to kind of start to run parabolic and we were going to see consumer debt really, really get out of hand in terms of personal income and people being able to pay their bills, right? But fortunately, that has not happened. And if anything, we've actually seen a little bit of a pullback or a decline in this rate, which, in my opinion, is a very good sign. We want to see this continue to trend lower, or, even if we see this just kind of sideline and consolidate and just kind of stick in this zone for a while, not really go crazy higher, maybe not go crazy lower, but just kind of steadily chug along. I can consider that to be a good thing because that's essentially putting us back to pre-pandemic ratios. The moral of the story is things are not falling apart like everybody said they would all of 2023. In fact, things are actually looking a lot better going into 2024 because the Federal Reserve is expected to lower interest rates. Now, I saw a lot of headlines about how the Fed's going to lower rates 6 times in 2024. You guys need to not listen to that. That is the assumptions that basically the Fed never said that they were going to have at 6. They give us a dot plot, which gives us an idea of where they think rates are going to land, but nothing is guaranteed. The Fed has told us things and estimated things before, and it didn't end up panning out as they had estimated. So don't think too much into that. If we do get rate cuts, they might be small rate cuts. They might be very slow to cut rates, just like they were slow to raise them. But either way, that is a potential good thing for stocks if rates do, in fact, go lower because that helps business investment, that helps real estate investments, and just getting the real estate market back on track helps people spend more money in the economy if they're buying and selling homes, things like that. So I think that if you see the Fed cut rates too aggressively, too fast this year, you should actually be concerned in the opposite direction because that means that the economy is actually not looking too hot because they cut rates when things don't look great, right? The Fed could very well not do anything too dramatic in 2024, but just enough to kind of keep things going the way they are. Of course, if a recession comes unexpectedly and slaps us all in the face at this point, we can revisit that at that time. But as it stands now, the data looks okay. The Fed could potentially lower rates. The stock market has continued to have strength. And if you've watched my videos in 2023, I've outlined why that could be the case, and it ended up being the case. And now I really do think that there is an even stronger case for stocks to potentially hold up from here, and we still won't see the big bearish sell off that everybody's hoping for. If we do see a sell off, it could very well come from higher prices. There are a lot of people that were not invested in 2023 that have a lot of cash thanks to high interest rates, paying them a bunch of interest, or them cashing out to kind of wait the market out. And there's a lot of money out there that could end up piling back in to stocks. I know I'm invested. I hope you're invested for the long run and you didn't get spooked out by the doomers and gloomers of 2023. If you like this video, I'd like to hear in the comments below. I did a little bit of technical analysis, pulling up the charts, talking price levels. If you like that kind of stuff, please let me know. Happy to do more of that, and I'll see you next time.